Hi, welcome back. And this video, I'm going to talk about the concept of the wisdom of crowds, and in particular, how it applies or shouldn't apply to financial markets. Again, it links to a free Substack newsletter that I wrote. So the link is in the description. So if you want to have a look at this in a little bit more detail, check out the newsletter and don't forget to subscribe as well. So, wisdom of crowds. Whether you're from a trading background or not, you may have heard of that phrase. It's used a lot in trading, particularly for those that are pushing technical analysis, trend following, any of those kinds of styles of trading. They'll say to you that, we have to follow the market is ahead, and that flows on because the crowd itself knows a lot more than individuals do, and that's why, for example, the market is ahead. Now, the market is ahead is a key assumption of technical analysis. It's important to understand that. If you use any form of technical analysis, you believe that the market is ahead. And the idea of the wisdom of crowds is linked to that, right? That the crowd knows what's going to happen and therefore is ahead. So let's have a look at the idea, the concept of the wisdom of crowds. So if you asked people, and often the explanation of wisdom of crowds that is most sort of commonly used is the idea that if we saw a buffalo in a field, and we asked one person to guess the weight of the buffalo, it's going to be very hard for that person to get an accurate guess. But essentially, if we asked 1,000 people, and then in what's found is, and it's actually been tested to be true, that sort of the average of 1,000 or a large number of people is actually going to be, not just better than the individual, but sometimes can be very close to the actual value that we're trying to discover. So from this, we get the idea of the wisdom of crowds. The crowd knows more than the individual. If you take the guesses of the crowd as a whole, you can get a much better perspective of the real value of whatever it is you're trying to measure. And so from that, in the trading world, we get the idea that if you follow what the crowd is doing, the crowd knows the wisdom of the crowd, therefore you go with what the crowd's doing, the trend, the momentum, whatever you want to say. There is a problem with that in the financial markets, and that's this. The example used of guessing the weight of the buffalo, for example, if we go back to that example, in the wisdom of crowds, there's a key element that I didn't mention in that previous explanation, which a lot of people are perhaps not aware about. That key element is that the crowd's wisdom is only valid if each of the, let's say, 1,000 people guessing the weight of the buffalo make those guesses independently without knowing what the others have guessed. So what we're saying is that we ask 1,000 people essentially to write down on a piece of paper what their guesses are. They don't know what anybody else guesses. And then we collate those 1,000 guesses and we kind of average them out. The average of those is a very good way of getting a much better value than necessarily one person. The problem in the markets is that's not what happens in the financial markets. Now imagine we go back to the buffalo example, and rather than everybody writing down on a piece of paper, without knowing what anybody else is doing and handing him in, imagine we do a different style of guess. And what happens is that each of the 1,000 people are going to get up one after the other and tell everybody else what their guess is. Now let's say the person number one is going to guess 1,000 kilos. Now person number two, in his mind, before person number one got up, was going to guess 200 kilos. Now he's heard person number one get up and in front of everybody say 1,000. Is that going to influence person number two? Absolutely it is. We know that from the way humans interact. Person number two, who was thinking 200, who, if this would have been an anonymous, blind, just write it down on a piece of paper type of survey, would have written down 200, is now going to change his or her opinion and may go to 300, for example, or 400. But given they've heard 1,000, they're unlikely to keep to something that's so far different. So the person number one has influenced person number two. That will also influence person number three and person number four. And this is a form of anchoring, in terms of the person number two is going to use that information, even whether it could be rubbish information from person number one. 1,000 could be completely wrong. And this is, if you've studied behavioral finance, and I've written about this in my books, this is what anchoring is about. It's using a number that you see somewhere else to base your decision on. Person number two has no idea what this buffalo raised, right? And neither does person number one. They're all guessing. In a blind type of scenario, we would have got 1,200 as our first two guesses. But now we're probably going to get 1,000 and maybe 300 or maybe even 400. So person number one has influenced person number two. This will go on to influence 3, 4, 5, and so on. So the outcome we get when people know other people's guesses is going to be significantly different. In fact, now the crowd helps to make a worse decision, because the early people, even if they're completely wrong, are going to influence the later ones, because we're watching what other people are doing. That is, in fact, how financial markets work. We are not all making guesses on what this stock's going to do tomorrow based on just, no information. We see what everybody else is saying. So if everybody else has been buying and driven this stock to $1,000, we're going to base our targets, our stops, and everything else we do based on that, and based on what other people have done. We see what they do. So financial markets, you cannot use this idea of the wisdom of crowds. If you see people pushing that, and they're pushing technical analysis or other methods because of the wisdom of crowds, it doesn't apply to financial markets. We are not making guesses blind. We are not making guesses without seeing everybody else. We see everybody else's guesses. That's why it doesn't apply. That's why the markets can be completely, inaccurate sometimes. They can blow away from fair value. Stocks can run up harder than crash and all those sorts of things, is because crowds in financial markets distort value sometimes. And the idea of the wisdom of crowds, therefore, if that's persuaded you to take on a style of trading, trend following or whatever, then, have a look now. Hopefully this will show you that it's wrong to be trading that way. So the wisdom of crowds is a very cool concept, and if people are making decisions without knowing what other people's views are, then absolutely we could use that. But that's not how financial markets work. So I think it's, hopefully, you found this interesting, and it may, for some of you, mean you rethink the way you trade and the way you think about trading. And of course, there's a number of ramifications for that. Maybe in the future I'll talk about others, but just to show one of them is, it means we have to have that ability to be contrarian, to say, hey, everybody's getting the complete wrong price of this buffalo because the early people in the buffalo were way too high or way too low. And so that ability to be contrarian, something I've always talked about and written about, is important in financial markets. You don't just always go with the crowd. The crowd can be wrong.